The final presentation for the day is called Business Transactions, Your Role. Very snappy, guys. And the presenters is my partner, John Yanak, and one of our senior managers in our Audit and Accounting Services group, Mark Wolstoncroft. So I'll turn it over into their good hands.
We had to make it snappy since we're the last session. We're on the last leg of this day of CPE, and we thought it would be a good idea to revisit the topic of business transactions, and that's for multiple reasons. I think first of all, we've seen a pickup in activity of deal flow. We've seen an increase in the prices that are being paid by companies that are out buying, or that sellers are getting when they're selling their businesses. So we thought it would make sense to revisit this topic. Our practice is integrally involved in these areas. We're involved in representing private equity firms and also acquisitive-related or oriented companies. And our clients themselves are good acquisition targets. They're small and medium-sized companies that are privately owned. They've done well in growing their revenues and making profits. So they're a good acquisition target for possibly a larger or a related company. And the transaction scenarios are not by any stretch of the means routine in any respect. I mean, they're non-routine transactions, and oftentimes what's happening is you have a business owner who, it's the culmination of their business career. They're selling their business. Or for a private equity group or a company that's out making acquisitions, it's a very important step in their growth. Jeff had mentioned earlier this morning that we have the good fortune of being able to work with very good clients and collaborating with them and working with them in a variety of areas. And this certainly is an area that the collaboration is very close. When you have a business owner that's looking to sell their business at the end of their career, or again, you have a company out taking a big step and paying a big price to buy a company, that deal is important, and the relationship that they have with us is important as well. So, on the sales side, we're usually involved in coaching them through that process, and what we really want to see is for them to maximize their after-tax deal proceeds. On the buy side, we're involved very extensively from a standpoint of helping clients to look at transactions, doing due diligence, helping them to structure to make the transactions less expensive, and then finally working in the purchase accounting and assimilation areas. So what are we seeing? From a deal standpoint, we're seeing the deals being priced at somewhere in the 6 to 8 times EBITDA range. I would say that 6 or 6.5 is probably more realistic. But we do see some cases where the multiples are stretching up to 8. And that might be a company where there's a lot of growth, there might be synergies, there might be a strategic buyer coming in that can eliminate costs and really recognize an EBITDA that is higher than what that company may be generating on a standalone basis. Remember, when I'm talking about the value of that enterprise, we're basically talking about the proceeds to the seller being absent cash and absent debt. So, a price is generally going to be tracked based on EBITDA. The buyer, does not take the cash that goes to the seller. The buyer also doesn't want to assume the debt, so the expectation is that the seller is going to pay off the debt in the transaction. So again, enterprise value is cash, is plus cash minus debt, and that's how you get your proceeds. Today, what we're going to do is, and I would also mention before moving on, is that the deal price is going to exclude any non-operating assets. So what might that be? It might be cash that has accumulated in the business over the years because the owner has operated the business very conservatively. It might be real estate that's not used in the business. It could be equipment that's not currently deployed. It could be all different kinds of things. So those things usually go to the seller as well. So today what we want to do is familiarize you with some market information, as well as covering the role of the CFO controller, talk about some general structuring considerations, due diligence, and finally wrap up with some real-life examples that maybe will be of help to you. We gave you a lot of statistical information in the back of the book in Appendix 1. And interestingly, the information that I garnered from a standpoint of deal multiples was based on my conversation with several private equity groups, as well as looking at the transactions that we've actually been involved with. But we actually went back and looked at FactSet Research Systems information that indicated that average enterprise value to EBITDA was up at over 10 multiple in 2015. Now, what does that mean? Again, you have to interpret that carefully, because that's for deals that range anywhere from $1 million to $500 million. So as companies get larger, as they have more revenues, as they have a bigger base of EBITDA relative to their revenues, the multiples are usually going to be higher. So my expectation is that, based on the market that we're working in, which is probably deals that are anywhere from $10 to $100 million, that those are going to be more in that 6 to 8 range. And as you get companies that are bigger, you're going to see those higher multiples. The other thing that's interesting is, as returns for investments have declined, there's generally been an expectation that pricing on these deals goes up. Well, what do I mean by that? What I mean by that is that the expectation by investors for investments in stocks and bonds has been moderated in recent years. So what's happened is that the expectation for what private equity is going to pay for a deal or for a transaction is not going to require as big of a return. The returns are relative. So if an average investor expects a stock and bond portfolio to return 6% over multiple years, which is lower than what you might have seen 10 years ago, you would have looked at maybe 8%, that private equity group can pay more. And that's driven up some of the pricing in the deals. The other thing that's happened is that money's cheap, at least right now. Borrowers and acquisitive companies can go out and borrow money for a relatively low price. And as a result of that, they can pay a little bit higher multiple for the acquisitions that they're looking at. Let's talk about some quick acquisition statistics. And I'm going to refer you back into Appendix 1 of your materials. If you have those in book form, or if you have those on your laptop. Just looking at the 2015 Merger Stat Review Summary Annual Information at the number of deals. So you can see that 2014 really represented a high watermark, not seen since back in, I guess, this 1999 period. So there are over 11,000 deals that were done in 2014. And if you look back in, or on page 11 of Appendix 1, you'll see that through September 30th of 2015, there are actually about 9,500 deals that have been done in 2015. So by all measures, it looks like the activity in 2015 is going to eclipse what happened in 2014. Finally, if you look back at page number 13 in Appendix 1, you'll see the sectors that have really led the way in terms of acquisitions. Probably no surprise, it's technology, commercial, and healthcare is basically where the bigger acquisitions are occurring. What were the bigger acquisitions? Here are the top 10 deals in 2015. Many of these are household names. And again, you can see the healthcare bent, you can see the consumer products bent, and the technology bent as well. And as many of you know, the Kraft Food Group merged with Heinz in 2015. We've seen the effect of that in the Pittsburgh market. That was the actually the fourth largest transaction in the market in 2015, interestingly. So the other reason that we thought we ought to talk about this is, it's interesting, acquisitions have become, very popular, and we'll see just how popular they've become over the past 15 or 20 years. But interestingly, there's high failure rate, 70% and 61% failure rates in two different surveys that we looked at. And then in addition, 89% of acquired businesses lose market share. So interesting, I don't know if that's the sellers selling at the right time, or I guess you could look at it the other way, the buyers buying at the wrong time. But with those kind of statistics, it's really important for CEOs, CFOs, controllers to be able to effectively analyze a transaction and a deal. Let's look at some of the trends. So 50 years ago, businesses typically pursued organic growth. And acquisitions started to gain popularity in the mid-1990s. So from 1990 to 1995, the average number of deals that were done on an annual basis was about 2,600. By 1996, almost 5,500. And again, in 2014, 11,240 deals. That's a lot of deals. Those are a lot of transactions and a lot of money changing hands. Today, mergers and acquisitions are really the vehicle of choice for private companies as well. Domestically owned private companies make up 57% of the transactions, which, we looked at that prior slide, the publicly held companies, they're the bigger deals, but in terms of number of deals, 57% are privately held companies. Let's see by a show of hands, how many of your companies have either been acquired or made an acquisition? Okay, if you look across the room, I don't know that it's 57%, but it's fairly high. So since the vast majority of our business clients are privately owned and considering the risks involved, we want to dive into this topic, a little bit deeper. Reasons to buy other companies can include gaining market share, entering new markets, acquiring technologies, and obviously integrating vertically. The best strategy is one where there's companies that do a lot of small deals, whether it's a private equity group or it's a company going out and adding to their portfolio of companies. Generally what is happening is by doing smaller deals, you're spreading the risk. Especially important when you look at the failure rate on some of the deals. We always hear those transactions where somebody goes out and gobbles up a company that's the same size as them or maybe even bigger, and that's pretty difficult to digest. So by doing those smaller acquisitions, you're essentially, what the authors are saying, is nearly doubling the return of intermittent buyers. So part of that is probably, you're minimizing the risk, but the process a little bit more effectively. You know how to go in and analyze the culture of the company, the finances of the company, the market share, and things of that nature. So Mark, you want to pick it up?
Sure. So what's your role? The first slide here talks about tempering emotions. Transactions can be tough on a CFO or a controller. There's a lot of work involved on top of your day-to-day responsibilities, and questions are coming from all different directions. You've got the buyers asking you questions, you've got attorneys asking you questions, CPAs that are assisting the buyers, insurance brokers, employee benefit plan consultants. Your current ownership is probably asking you how the process is going, and then you may have employees that have questions too, if they're caught whiff of anything going on. So it's a time where you have a lot of work on your plate, and it's important to temper emotions from that perspective, but it can also be highly emotional for both the buyer and the seller. Both because, John mentioned, it's really for a lot of sellers, if it's a seller that's built this business from the ground up, and it's been their livelihood for 30 or 40 years, they're emotionally attached to it, and it's a one-time scenario, and it's probably one of the biggest events in their life. So definitely can be emotional from that point. You could tell that these materials are, this is an educational seminar for accountants and not a marketing material going to business owners, because I'm pretty sure if it were marketing materials going to business owners, we might not have, oh, where'd my slide go? Oh, they even changed it. The slide I have says ego rather than strong personalities. And I thought to myself, if this was a marketing seminar, it would probably say strong, decisive personalities that have leveraged their strengths in building something meaningful. But we all know that there can be strong personalities, especially when folks have worked hard to build something that's meaningful. And then deals can have a life of their own. What I mean by that is the buyers want to manage risk, and they may leave no stone unturned, when they're going through the deal. It'll seem like an endless list of questions sometimes. And another thing that can happen is financial buyers might look at the business using an MBA-style approach, whereas the sellers may be more operationally oriented people. And so, there's some tension that comes there. And really, you as a CFO or a controller end up in the middle of all of that, in the middle of some of the emotion. And really, I think one way to deal with that is to focus on the measurable facts and help to diffuse some of that emotion. So,
Mark, I was just going to say, the other thing with these deals sort of getting a life of their own, as Mark mentioned, oftentimes there's a very aggressive or extensive diligence process that goes on. There's a lot of money spent on attorneys, on accountants, on environmental consultants, et cetera, and a deal gets, so far down the tracks, and it's hard to let go. If a CEO or a CFO is, driving a particular deal and wants it to happen. And Mark's going to talk about that a little bit in terms of, some things that you folks need to think about if your companies are doing transactions.
One way that you can focus on measurable facts is to set financial limits. And that probably means, two different things, whether you're on the buy side or the sell side. But some financial limits would be rate of return requirements, if you're on the buy side, revenue growth targets, operating margin targets, the deal price, obviously, and maybe, some walk-away issues. On the buy side, you really want to understand and help set those financial objectives. You're going to measure those and monitor those during the due diligence process. And you're going to want to understand the working capital implications and plan accordingly. We'll talk more about working capital shortly. If you're on the sell side, you're probably taking, a lot of information either from your owner's expectations relative to his sales price, and maybe working with an investment banker to help set that target, and you'll be equipping that investment banker. We're going to talk more about due diligence in a section a little bit later, but some aspects of due diligence would include, is this business a good cultural fit for the folks who are buying it? You're going to be trying to evaluate the management team and trying to retain some of their personnel. You may be doing market or customer surveys, evaluating operations, doing a financial review. You may be evaluating whether additional investment is required, and obviously, looking at how you're going to finance the acquisition as well.
Mark, that's an interesting topic. Sometimes this additional required investment gets lost in the dust. We had a client a number of years ago that bought a company for what looked like a song. It was $4 million, but what they really didn't take into consideration from an operational perspective was that they had to make about $25 million of capital improvements in the business. It was a business that was not doing particularly well. It was available for the low price, but the equipment had really been sort of let go over the course of a number of years, and it had to be refurbished, and a lot of new equipment had to be added in. So the operational side of that diligence process, by the acquiring company just wasn't effectively done.
You're scaring me, John. I'm looking at buying a house right now, and that's how I feel about it. There might be a lot of work to be done. Keeping a foot on the brake is not a foreign concept to many of us in the room. But it is easy during a transaction to become invested in making it work. CFOs and controllers bear a significant brunt of the due diligence process, and it can be tempting to isolate yourself during that process in order to keep up with all of the information requests and on top of your day-to-day duties. Some ideas are involving folks with different perspectives that can help focus on the big picture. You want to be managing risk by maintaining ability to modify terms and structures. What I mean there is really the seller is often more knowledgeable about the risks than the buyer is. They've been running the business. They know the risks pretty well. So you may want to anticipate some of the questions and be prepared to respond to the buyer's perception of those risks. I mentioned that I'm in the process of trying to buy a house. And I say trying because the house was on the market for 9 months. We made an offer. I think it's a pretty good deal, but when we went for the inspection, we turned on the tub in the master bathroom, and all of a sudden there was a waterfall in the living room. So what I thought was interesting about that relative to this topic is that the seller's realtor was there, which I thought was unusual. A lot of times the seller's realtor isn't at an inspection. And I can't help but think she was there because she thought that tub could leak and wanted to help mitigate the risk by helping with the process. So if you're a seller, you might want to think about how to mitigate risks and help get the buyer to the other side of the transaction. On the flip side, buyers are wise to be flexible. You're going to run across challenges and hurdles during the course of the deal. And I think it's helpful to keep your mind on what's the value on the other side of this deal. There might be a lot of value on the other side of this deal, and maybe it's worth an investment to help mitigate some risks, and maybe it's worth some concessions if you need to make them. As far as John's going to talk about tailoring terms of the deal, I'm going to skip that for now. And then, lastly, as far as your role is concerned, once the deal is done, there's still a lot of work to do. Feels good, it's done, but there's still a lot of work to do. The integration of technology is an important part of that. It's helpful to establish some integration teams and divide and conquer. And then, as part of your role will be developing realistic goals for performance. Hopefully that's informed by your original assessment of the business and your original plan, and you've modified that during the due diligence process. I'm going to turn it over to John to talk about the structuring transactions.
Yeah, we want to talk just for 5 minutes about some general structuring transactions. I mean, this is a subject that we could probably spend a half a day or a day on in and of itself. But what we want to convey to you is that buyers generally want to buy assets. They generally want to write those assets up to obtain the tax deductions associated with the write-offs. Those tax deductions help to pay for the deal. What do the sellers want to do? The sellers generally want to sell their equity interest, especially if it's in a C corporation, to achieve capital gains treatment and to, quote unquote, walk away from the liabilities that are within that company, whether they're stated or unstated obligations. C corporations, again, create the most tension because there's 2 levels of tax present. A C corporation owner, if he's selling assets, there's going to be a tax at the entity level, and then when the money's distributed out, to the seller, there's another level of tax. So you can see why they generally are going to want to sell their equity interest in a C corporation. The accounting and financial reporting for the transactions is the same under a stock or asset deal. The assets and liabilities, must be reported at fair value. And believe it or not, it creates a potential for gains at the date of acquisition. So for all those older CPAs in the room, you remember you could never have a gain until you had completed the earning process, i.e. you had sold the particular asset. In the acquisition accounting as it currently stands, if you happen to buy a business at a bargain price, that is to say that you buy that business for less than the value of the assets in that business, you can actually have a gain. Appraisals are generally required for all of your non-current assets, and that's a little bit less true than it was maybe before the most recent change in the purchase accounting literature. As Jeff mentioned this morning, if the only intangibles that you have are goodwill, customer lists, and things of that nature, you can elect to include that all as goodwill and to amortize it over a period which is no more than 10 years. When that rule wasn't in effect, it created some hardships for private companies that were going out and buying companies because they had to go out and get these intangibles appraised or valued. A lot of private owners didn't want to do that, and they actually took qualifications to their audit reports. Transaction costs are going to be expensed for financial reporting purposes and generally capitalized on the acquisition. So I want to refer you back to Appendix 2 in your handout materials, and I just want to go through a very quick example of that to give you a sense of what that can mean in an actual transaction. So assume a buyer acquires a company for $20 million and incurs transaction costs of $2 million. Let's assume that the tax basis of the assets is only $6 million and the fair value of the assets is $20 million. So from a financial accounting standpoint, the accounting is going to be the same. The assets are going to be valued at $20 million in a stock or an asset purchase scenario, and the transaction costs are going to be expensed for financial reporting purposes. But what happens on the tax accounting side? On the tax accounting side, if the basis of those assets is only $6 million in the hands of the seller before the transaction, that buyer is only going to depreciate or amortize the $6 million in old basis, I'm going to call it, after the acquisition is completed. On the other hand, if that buyer makes it an asset transaction, he can write the assets up and basically get the increased amortization and depreciation over the course of the time that he holds those assets. Now, in the end, it all equals out because, if in the end that seller essentially sells the business, he still has basis of $20 million that he can deduct against his sales price. But it sure is nice to have the write-off of those assets post-acquisition to help fund the deal and to repay the debt that would be associated with the deal. We actually had an example of this a number of years ago. We had a client that was acquiring a small company. They were going to buy the stock of the company, and the owner of that company owned some patents as well. The buying company was going to have the seller contribute those patents into the company and pay him $4 million, for that company. What we recommended as a spin on that transaction was pay him $1 million for the company and pay him $3 million for the patents. The patents is where the value was. The patents were held by the owner. So what that essentially did is it allowed that buyer to amortize those patents over a 15-year period of time and achieve tax deductions, and there was no adverse effect on the seller, as both the sale of the stock and the sale of patents were capital transactions. So I just want to mention that. Again, the buyer in this deal gets $16 million in tax deduction during the ownership period, and there's cash value associated with that. The other thing I want to mention, real quickly is just sort of going back to this prior slide, we do sometimes see circumstances where, buyers want to pay substantial bonuses to, sellers in conjunction with a transaction to get a tax deduction. That can be done within some constraints, but, you have to be careful that there's not some disguised deal consideration that's being achieved. Now, a seller is generally not going to want that, but buyers sometimes try to use that kind of a technique to make the deal a little bit better from a cash flow standpoint. In addition to traditional structuring issues, certainly entity considerations are important, and we'll talk about some examples of that a little bit later on, as well as talking about what is paid for different assets. Mark?
As promised, we're going to talk some about the due diligence process. The amount of due diligence and the number and qualifications of the people that can be involved in a deal will vary from deal to deal. On a smaller deal, there might be less risk and less need to have a lot of people involved, but certainly if there's a larger deal, you're going to want to have a team of folks involved with evaluating the deal. Sometimes that team of folks will include your own management team that has some expertise in probably evaluating at least the operations. Sometimes you'll have, almost always you're going to have attorneys involved, right? Like everything else, there's going to be attorneys involved. And they're going to be, drafting the agreements and assessing various types of contract risks. You might have an environmental team out there assessing any environmental issues for potential liabilities. You may have an insurance team out there evaluating insurance evaluating risks and designing an insurance package. You may have market research or customer surveys. And of course, today we're going to focus on the accounting piece of this. Our firm's due diligence is generally structured as a consulting engagement. Sometimes it can be pretty broad in scope and flexible in scope. Other times our clients want that to be pretty specific and tailored as an agreed upon procedures type engagement, covering specific topics. And in those cases, our reports will often be 100 pages long, and it'll list everything they wanted us to look at and our response to the questions we've asked of the sellers and our observations. And then, oftentimes after that report, we've also gathered a lot of information during the process that will append to that report. So there's a nice package there for the buyers and for the folks that will be managing the business. It really helps kind of put a lot of information in one place for them. It may also include audits of historical information, and sometimes helping develop pro forma or prospective information as the buyers consider what the deal might look like afterwards. The scope's going to be dependent on the size and complexity of the deal. The scope of the due diligence is going to be dependent on the size and complexity of the deal, the buyer's expertise, the risks that are identified, and the type of transaction that it is. Often our services begin with gaining an understanding of the deal and helping on the consulting regarding potential structures, as John's talked about that. And then when we move into the due diligence phase, often, as I mentioned, we're collecting a lot of information, we're making inquiries of the seller's management, and we're summarizing the results of our work. So what happens during the course of our engagement? Often our services result in assessing the impact of future taxes and financial reporting. That's really happening at the front end as we're assessing the structure. We may end up recommending changes to the structure or timing of the transaction. Oftentimes during the due diligence process, you find out new information about the company's real earnings. We'll talk about a quality or earnings analysis in a minute. That can, serve to change the deal price. Kind of like when I found the waterfall in the living room. That's going to change the deal price of the house. And then organization of information and an increased understanding of and comfort with the target's reporting. This is something that, my clients, when I'm involved on these deals, really have indicated that they appreciate about the deals. Because a lot of times when you're dealing with somebody else's records, you're not quite sure how everything fits together. You're not quite sure how every report reconciles. So we're spending a lot of time out there at the seller's location. We're understanding how their reports fit together. We're reconciling items, and that makes it easier for the buyers to analyze the business and to make decisions. And then, as I mentioned afterwards, it's helpful for the new CFO or controller to come in after the acquisition. The process is designed to assist in assessing issues that impact valuation, true condition, buyers' business plans, and risks. We'll talk a little bit about that on the next slide. I want to focus on a key component of the diligence process, or maybe even you might look at it as the output of the diligence process is often a quality earnings analysis. And when we're doing a quality earnings analysis, you're generally starting with earnings before interest, taxes, depreciation, and amortization per the seller's records. And then you're adjusting that for things that you find during the due diligence process. Historically they haven't accrued for vacation. What was the impact of that on the most current years, and how does that impact earnings?
Most of the value that a company's going to pay for when they're buying another company is that EBITDA. I mean, they are concerned about the assets they're inheriting or the liabilities that they're assuming, of course. But this is really sort of the big focus on that diligence, because they're buying the earnings or the cash flow stream on a go-forward basis, and the assumption is that you have, basically a good pool of assets there to start with.
Yeah. This analysis really can be detailed, and it can be sensitive. I mean, if you think back to John's comments about the EBITDA multiples that are being paid, if you're buying a business that has $1 million of EBITDA, you think it has $1 million of EBITDA, and you're going to pay $5 million for it, and then you find out that it really has $800,000 of EBITDA, that's going to have a 5 times impact on the purchase price. So it's an important analysis, and every dollar that you find is magnified. The third thing that can be taken into consideration is prospective efficiencies or costs. We've done a few due diligence projects that were unplugs from publicly held companies, and so they were essentially, the buyer was buying a manufacturing facility from a publicly held company, and as you can imagine, that company's P&L for just that plant isn't comprehensive relative to what the earnings would look like, because the bigger company is handling some of the administrative burden. So we helped evaluate what the administrative burden would be after the unplugged, and put that into the quality of earnings analysis. A couple other examples. We've seen it. You won't be surprised by this, but sometimes businesses are tax motivated and do everything they can to reduce their income tax expense. We saw a deal recently where it was a stock deal, and it was a C Corp, and the company had treated payments to the ownership group as compensation rather than as equity. These were significant payments to the ownership group, well above what would be considered reasonable compensation. We did an analysis, a couple versions of the analysis, but in the end we determined that the potential exposure to the buyer would be $1 million if there were to be an audit, an IRS audit of the company, because remember, they were buying stock, not assets. So if there were issues with prior tax returns, the company would inherit those issues. So that was $1 million on a $15.5 million purchase price. In that case, the buyers and the sellers agreed to mitigate that risk by basically putting that $1 million into escrow. And if the period cleared without an IRS audit, then that money would pass as purchase price. Otherwise, it would be used to pay the liability. We saw a somewhat similar circumstance on an asset deal. Again, this might not be surprising to you, but this was a metals-based business, and sometimes folks will play games with the scrap metal. So in this case, the scrap metal was essentially the owner's fund money. He would take the scrap to the scrap yard, he would get cash for the scrap, and he wouldn't report that in the business. I don't know if he would tell his wife either. But he would have cash to do the things that he wanted to do. So there's a couple, in an asset deal, you're not really that concerned about the tax audit implications, but it is an EBITDA issue, and actually it's an EBITDA issue that would be in favor of the seller, because if he had reported that in his earnings, it would have increased his earnings. But of course it was hard to figure out the magnitude of that, because how do you figure out how much somebody pocketed from scrap sales? So a couple examples. I'm going to turn attention to working capital. In my experience, working capital is an area that can be overlooked during a deal. A lot of time and energy is spent on negotiating a purchase price and on other legal and other deal issues, on structuring matters, etc. But it's not uncommon to see working capital issues towards the end of a transaction. I'll give you, if you'll bear with me on an example here. You guys are good with numbers, right? Oh, wow, that was bad. Come on, wake up. We have a purchase price at $10 million, and let's say the working capital has historically averaged $2 million, but there's not a working capital target set. We go to closing, and over the last month, the sellers decided that they weren't going to pay any of their payables. They just stopped paying payables. And so when you get to the closing date, the business has $1 million less working capital than the buyer may have been expecting to receive. If you don't have a working capital target, you have an issue there. You have $1 million of missing assets. If you set a working capital target early on that results in a purchase price adjustment, you might have said, hey, we'll pay you $10 million, but you've averaged $2 million of working capital over the last year. We want to make sure you deliver $2 million of working capital. And if you deliver more working capital than that, we'll pay you more for the business. And if you deliver less, then we'll pay you less for the business. So it's important to, you can imagine that it's not easy to come to agreement on what average working capital is in some cases. Sometimes you might want to look at average working capital over a period. Sometimes if it's a more cyclical business, you may want to be looking at the same period as last year. It might be most applicable to look at what the most recent working capital numbers are if there's been some changes in the business that are expected to be similar moving forward. Or you may want to take another approach and look at pro forma. But that's an important consideration Another time where we've seen some difficulties with working capital calculations, we've had clients who have set targets and have put some good thought into setting a working capital target. But if you have a target that doesn't have real good financial statements, you can have some issues. And let me give you an example of that. So you go through and you're using the seller's financial statements to set a working capital target, and you figure out that they have $2 million of average working capital, and you're both comfortable using $2 million as a working capital target. But then when you go to do the beginning balance audit procedures and you go to finalize the working capital, you find out that they have not accrued for certain things. They weren't doing true GAAP basis financial statements. So now you've discovered a liability that, really should have been in the calculation of the target that wasn't in the calculation of the target. And what we've seen is sometimes you're not able to recover that in the working capital adjustment, but the other recourse would be to try to recover that as a claim against the escrow account. But we've seen some complications with that, on some deals. Some other things that can complicate the working capital, to the extent you have a mid-month close, if you have a mid-month acquisition, because it's different than what you usually do as an accountant, sometimes there's some different considerations that need to be given to accruals and to prepaids and to other accounts on the balance sheet. You may have liabilities that are not traditionally recorded at interim dates. Sometimes you see that with accrued vacation or accrued bonuses. And then you can have some post-closing settlement developments. GAAP generally provides that all the facts and circumstances that you know at the time that the financial statements are being produced can go into, the evaluation of the balance sheet as of that transaction date. How are we doing here, John? We're running out of time.
We're running out of time.
I'm going to turn it back over to you because I know you might have had one or two more examples.
Yeah, I just want to go over a couple of other examples. Mark, mentioned the idea where you have an inventory issue. That can create a lot of problems if a business owner has not accounted for their inventory in the proper way. And depending on what the real inventory is at any particular balance sheet date, that can affect the earnings. That can be very problematic, and we've run into that. The other thing that we've run into is cases where we had contractors that really didn't use percentage completion accounting. I don't know what basis of accounting they were using. I think it was sort of the flavor of the day. And that was very problematic because we really couldn't get a handle on what the earnings of the company were, and the buyer was just not comfortable moving forward because of that issue and because of a multi-employer plan issue. We've also seen circumstances where we're representing a buyer. We had a seller who was represented by another firm, and that seller's accountant did not properly evaluate the tax consequences of the sale. In particular, they didn't look at the recapture obligations that were associated with the sale of equipment within the business. And there was actually a $1 million additional tax amount that seller had to pay, and he did end up pursuing his accountant for that. The last item I want to focus on is a transaction that we worked on, and this is sort of interesting. We had a company, we had an acquisition LLC formed. They were looking at an acquisition target, which was a C corporation. So the facts were that the acquisition company was borrowing the money to acquire stock from an individual owner. The target plans to distribute money to the acquisition company to fund the debt payments. What's the issue? The dividends that are paid by this company, which is a C corporation, are not tax deductible. However, the dividends are taxable up here in this LLC, which is a flow-through entity. So what we actually did is we restructured the transaction. There was a new LLC put above this acquisition LLC. And essentially what happened, and my artwork isn't the best here, but essentially we merged the acquisition LLC, which held the debt and the investment in the stock, down into the acquisition target so that the debt was down at the operating company level and the company didn't have to dividend money up to an LLC where it would be taxable. So essentially, you know, what we did is create a scenario where we avoided a big problem and had a scenario where the interest expense could be deducted by that target company, that target operating company. So Mark mentioned some examples on working capital. I mentioned, you know, examples with respect to inventory, structuring, and what assets you buy and what you pay for those assets. These are issues that arise on almost every deal. They're very complicated. No two deals are the same, and as Mark mentioned, it's a very emotional issue for the seller. So, you know, we thought it made sense to go over this. We appreciate your attention today.